Hi there, welcome to the swap video. What is a Forex swap? What does that mean? We're going to look at the central bank interest rates, swap formulas, and a couple of other terms that you're going to hear that mean the same thing. Swap, what does it mean? You're going to notice that you're going to get paid for holding a position. Every once in a while, you're going to see that you've gotten a couple of extra bucks just for holding a position. This is the swap. It appears in a different column in your account history. You'll get paid, or sometimes you'll be deducted. You have to pay a swap. Now what happens is at 5 p.m. Eastern, all accounts are closed and instantaneously reopened. This is the swap transaction. Now central banks lend money to their banks at a certain interest rate. This is critical to the swap. The interest rate is known as the discount rate. Now each country has a different discount rate. And this is important because as Forex traders, we are trading different countries' currencies. At the moment, the central bank rates are Australian dollar is 4.25. This is the Australian Central Bank lending money to its other banks at this interest rate, 4.25% a year. And you'll notice the US is offering their banks at 0.25%. So over the course of a year, the banks that the central bank lends money to has to pay 0.25% in annual fees, annual interest rates. And because as currency traders, we are buying and selling these different countries' money, these different countries' currency, we pay or have to get paid according to the swap, according to the interest rates. So if you are buying a currency with the highest interest rate, you're going to get paid the swap. If you are selling a currency with a high interest rate, you're going to pay the swap. And the best example is the Australian dollar, US dollar. The math is simple, so it's going to be very easy to explain. In the currency pair, Australian dollar, US dollar, the Australian dollar being the base is going to be the first currency pair, and country's interest rate is 4.25%. The US dollar, 0.25%. So if you're buying the currency pair, Australian dollar, US dollar, you'll be buying the Australian dollar and at the same time selling the US dollar. So the difference then becomes 4.25% is what you're going to get paid. 0.25% is what you're going to have to pay because you're selling. That equals out to 4% in your favor. If you're buying the Australian dollar, US dollar currency pair, you get paid the higher interest rate and you have to pay the lower interest rate, which means you're going to end up ahead. You're going to end up 4% ahead. If you were selling the Australian US dollar currency pair, you would have to pay 4.25%, but then you get paid 0.25%, which means you would owe at the end of that transaction. Now here are a couple of fancy formulas. Swap for buy orders gives you the contract size, which would be the lot size, 100,000, 1,000, 10,000, times the base currency's interest rate, minus the quote currency's interest rate, and then you've got to add in the broker's markup, divided by 100 times 365. That's how many days per year. Swap for sell orders, contract size, times the quote currency's interest rate, minus the base currency's interest rate, plus broker's markup, divided by 100, divided by 365 days a year. And we'll throw in some numbers into those equations. Example, the Australian dollar, US dollar. Now this is to figure out what you're going to get paid per day. So if you're trading a full lot, which is $100,000, and you're buying the Australian dollar, US dollar, the swap is going to equal the contract size, $100,000, times, now we work out what's in the brackets, 4.25 minus 0.25 gives you 4, plus 0.15, which is the broker, gives you 4.15, divided by 100, divided by 365. And at the end of all of that math, you get 11.37 units of the base currency, the Australian dollar. So you're going to get paid per day because it's divided by 365, 11.37 at the end of the day during that swap at 5 p.m. Eastern. Now, if you're selling the Australian dollar, US dollar, we'll plug in the math, all the numbers. So at the end of the day, you're going to end up owing, or you're going to pay, this is going to come out of your account, $10.54, Australian dollars, because it's the base currency pair. So you're going to owe $10.54. It will be automatically debited out of your trading account at 5 p.m. Eastern when the accounts are automatically closed and instantaneously reopened. That number is going to magically disappear out of your account because you are selling the high interest and buying the low interest currency. A couple other terms that you're going to hear for swap is rollover or carry. And this particular holding of this trade during the rollover, during the swap, 5 p.m. Eastern, is an actual trade in itself. It's called the carry trade. So you can buy the Australian dollar, US dollar at a minute or so before the rollover and then make money on the swap and then close the trade. That has been done. That's a trade in itself. It generally, though, works not in your advantage because the spread will be more than what the swap is. But that is a kind of a trade, as a carry trade. Thank you for watching. We'll see you in another video.